Jerome Powell just brought the bull out of the cage with this FOMC report. Guys, we're going to get into the report that came out at 2 p.m. today, as well as the press conference, because that's where a lot of the juicy stuff was. And this is what could potentially cause this 2023 bull market to get that much more intense. You guys think it's already been a pretty good ride so far in 2023? Well, buckle up, because Fed Jerome Powell signaled it is a-okay for the stock market to be at its current levels, as long as the big bad wolf does not come blow over Apple, Google, or Amazon tomorrow and after hours. That's going to be your last speed bump before you can officially be in a new bull market. I'm just so used to saying bear market at this point. A new bull market. Guys, let's get into everything that happened here today. So, the Fed press conference. That's where a lot of the juicy stuff happened. That's where a lot of the actual signals of a Fed pause occurred. But the actual report was also very bullish. Now, I want you guys to take a look at the S&P 500 chart. Initially, you sold off quite a bit, and then you rallied once the markets realized, hey, a lot of things have changed from the December FOMC report to the report that we're getting now. And what I mean by that is the markets, they look at the statement and they say, what was taken out from the last one? What's essentially new in this statement compared to the last one? I guess that's the best way to put it. And initially, the bearish thing was the Fed said ongoing rate hikes will be needed to tame inflation. They did not change that from last report to this report. But what was bullish in this report was this. The Fed said COVID, the war in Ukraine, and supply chains are no longer causes of inflation. I mean, what? That's the main causes of inflation. They're what, now gone? Apparently, according to the report, they are no longer affecting the inflation outlook. And that was really the main point of the report. That's what really had the markets at a neutral point. People thought ongoing rate hikes meant plural, meaning that not just this one, we're talking the next one and maybe one after that. Excuse me. That was the bearish part. Bullish part, looks like the causes of inflation are gone. So that was good. Now, the press conference is where things got a lot more bullish. And that's where the S&P just went up and pretty much went straight up. And why that was really the case is a couple key questions. And that's what we're going to talk about right now, because a lot of questions that Jerome Powell is asked are not important at all. Really, in the grand scope of things, a lot, like 80% of the questions really don't mean anything, or they're not going to be things that can move the markets. That other 20% is what gets the markets really pumping. And it was this main question right here. This is actually the first one I wrote down, the first one that I thought was important. He was asked, financial conditions have loosened over the past couple of months. Will that mean the Fed has to raise rates higher? And he completely dodged the question. He said, no, it doesn't necessarily mean that we'll have to raise rates more aggressively. He literally dodged the question. That is bullish. He could have had his chance to knock down the markets. And essentially what that question was saying is, do you think it's appropriate that the stock market is, expecting rate cuts, or the bond market, I should say, and the stock market is following suit? It's been pretty much going up throughout all of 2023. Is that okay? That's essentially, if you want to boil it down, that's what that question was. It was Fed Jerome Powell's opportunity to say, this rally is not okay. This is not what we want to see. This is a problem for our fight against inflation, and there's no way the markets are correct. Because after all, the bond market's pricing in 1 to 2 rate cuts by the end of the year. That's not necessarily a bullish thing. So in the grand reality of this whole situation, over the next couple of months, this is very bullish. Over the 6 to 9 months from now, that's not such a bullish thing. And we'll also talk about, the bullish and the bearish in this video as well. But that was big. Fed Jerome Powell, he thinks markets are appropriately discounting Fed policy. That's literally what he said. Massively bullish. Now, he did say that one thing that has them a little bit concerned over at the FOMC board is that core services ex housing inflation is not coming down, or at least they're not seeing signs that it's starting to come down, right? They're not getting soft data that's showing core services excluding housing is coming down. And he said that could be a real sticky spot, and they're going to have to watch that and pay attention to those reports closely when they do come out over the next couple of months. And the markets they already know that, right? And he didn't hammer it home that that's really a reason they would continue to raise rates super, super aggressive. He also did say that disinflation has started. Now, if you guys don't know the difference between deflation and disinflation, they're relatively similar, but a lot different. So disinflation, for an example, say your phone, for an example. I don't know where you get a phone for this price, but we're gonna call it $100. You get a phone for $100 in 2023. Well, let's say that phone in 2024 is $105. That's 5% inflation. Let's say that phone in 2025 is $107. That's, less than a 2% increase from, theoretically, right, 2024 until 2025. That is, the pace of inflation is slowing down. It's going down year over year or month over month. But deflation would be if you bought an iPhone this year at $100, or any phone, you're not getting an iPhone for $100. For $100 this year, well, next year it's going for 97 or 98. Then you got 2 to 3% deflation. So big difference. And deflation is actually worse than inflation. So disinflation is what you want to see. That's ultimately what the Fed's trying to do, is just get inflation down, to slow the pace down to a 2% target range for the federal funds rate, or for inflation. So that was huge. The Fed, for the first time, acknowledged that disinflation is currently taking place, besides in core services ex housing. So that was also important. He was also asked, why not just pause here? I mean, it looks like things are going okay. It looks like inflation's going down. There's not really a huge chance inflation's going to go back up because, after all, inflation expectations are going down still, which that's the main driving force of inflation. And a lot of people don't agree with that, but it's kind of true. Imagine if you're a restaurant worker or restaurant owner, I should say, and people are just expecting, your customers, that the price of food is going to go up because the price of eggs are up, or the price of milk is up, or whatever else is going on. But people expect to pay more for that product or service a year from now. Well, why would you not raise prices if you were that restaurant owner? But if people don't expect, prices to go up, or they, just don't expect it, I mean, you're probably not going to raise prices. You're probably not going to piss off your customers. You're probably not going to lose business by pissing off your customers. You don't want to do that. That's bad business. So, that's not happening. And that's a good thing. But he says we still need a couple more rate hikes to kind of get to that place where we could pause rates. He didn't necessarily say that we're going to pause rates here shortly, but he didn't disagree with it. This is like one of the first times ever, at least from, the COVID era, that he kind of is okay with where things are at right now. And overall said more positive things than negative things. Like there was very little negative that was actually said on the press conference. A lot of people and analysts, when the press conference was actually happening over on Bloomberg, were like, what's going on? We all thought the Fed was going to be hawkish. And that's a main part to why the markets are rallying too. We all thought the Fed was going to, give us a 25 basis point rate hike and then be very hawkish and try to talk down this market. Kind of the opposite happened, right? You got a 25 basis point rate hike, and he kind of talked the markets up in a weird way. So all in all, guys, that was very positive. And how this is really bullish over the next couple of months is exactly what we just talked about, right? The Fed pausing, just the earnings coming in a little bit better than expectations, right? They could have been a lot worse, and that's why stocks like Facebook are up 20% in after hours, or some stocks that, you know, did bad relatively, right? That kind of missed on earnings, but it wasn't too bad. You could say Microsoft is a good example of that. They kind of missed across the board on earnings, and the stock was up 5% in after hours. But then on their guidance, or their guidance on their earnings call, the stock dropped like 1 to 2% the next day because they gave bad guidance. So the earnings are a little bit better than expectations. The Fed is okay with where the markets are at. And valuations don't look too bad if we don't go into a recession. So for all of those reasons, the markets are likely to go into a new bull market in 2023. From this point on, I could easily see the S&P 500, getting back to those August 2022 levels around 430, maybe as high as 440 or 450 over the next coming weeks. That would be like a 10% rally from here to get back to 450. I think it's very well possible and probably probable at this point. But then at the same time, this is not bullish for the longer term of 2023. Let's call it that 4 to 9 month period from now, after, call it a couple months. You could be pretty bullish for a couple months. But after that, not so good, because historically the markets, they rally when the Fed raises rates, because historically if the Fed is raising rates, the economy should be doing okay. And that's what has happened over the last year now. The economy did okay, but the markets did not rally in anticipation of a recession and growth slowing down. So good examples of this are over the last 23 years. From 1998, the Fed funds rate was 4.68%. The Fed took the Fed funds rate from 1980 or 1998 until 2000 to 6.5%. They paused, they started to cut rates, you went into a recession. A better example that a lot of us have lived through was May of 2004, the Fed funds rate was 1%. And by February 2000, or from, when did they pause? It was right here in July of 2006. They actually paused until June of 2007. They actually started to cut rates, and then you went into recession. Now, if you were not invested during this time, you looked like a dummy, right? If you didn't own your own house at the very least and have a 401k, you look like a dummy, right? Obviously not when the recession came. Obviously then you look smart if you didn't have these things. But long story short, the markets actually rallied during this time. When the Fed paused was really a time to question if you should be in the markets. When the Fed cut rates, it was like everyone wanted out of the markets at this time. Even same thing to a lesser extent back here in August of 2015, the Fed started to raise rates up until 2019. They took the rates from 0 to 2.5%. Then they started to cut rates, and the yield curve actually inverted in August of 2019, signaling a recession was coming. And then you had this slight COVID recession, and some would argue you would have had a different scenario play out. Maybe you would have had a longer term downtrend in the markets if COVID would have not happened and the Fed didn't bail everything out instantly. Well, now look where you're at. You've been going straight up, right? So if you get that pause, historically 90 days after a pause, the Fed cuts rates, and when the Fed cuts rates is when you really don't want to be in the market. So over the next couple of months, this looks to be a very positive thing. Over really the next 6 to 12 months, this looks to be a pretty negative thing. So I want to give you guys the good and the bad. And that's the good, that is the bad about what is going on. The last real hurdle that we have to get above is going to be Amazon, Apple, and Google tomorrow in after hours, or today in after hours, depending on when you are watching this video. If you can get good earnings out of these three names, I mean, it's a new bull market for 2023. Fed Jerome Powell saved the day. You could probably be safe owning equities for the next couple of months because the Fed's out the way. That's no longer a risk factor. Earnings at that point would be out of the way. That's no longer a risk factor. Inflation, the next inflation print that we're going to get, call it in about 10 days or so, 9-10 days or so, is probably going to be pretty good as well. That's not a huge risk factor. If it goes up, it could be. It's not expected to. The soft data that we've gotten so far does not look like that's going to be the case. The only real hurdles for the next 3 months at that point would be if economic data starts to get worse, because bad economic data will be bad news for the stock market. Good economic data will be good news for the stock market going forward from this point on. And I just don't see the economic data deteriorating super aggressively. To a certain extent, yes, but have the markets already priced that in? It looks like it. And until earnings really come down in a big way, you might be a-okay. So hopefully you guys liked this video. Hopefully you learned something. If you did, hit that like button. And not only that, subscribe to the channel if you guys want to stay up to date with all of this information. Thank you for watching. Tell them hit the like button.
Like button.
Hit the like button. It's official. You guys enjoy the rest of your day. I will see you in the next one.